Crypto value investing might sound like an oxymoron, but in today's video, I'm going to give you a framework for investing in cryptos based on their actual earnings that they produce by providing on-chain financial services. We're going to look at these various decentralized finance protocols as the businesses that they are and assess their financials over time. By the end of this video, you should understand how to find cryptos that are both fundamentally sound and oftentimes that even produce passive income if you invest in them. All right, now let's get into it. Before I go any further, I want to remind you that nothing I say in this video is financial advice. I'm going to go through a lot of example tokens, example crypto protocols. I'm even going to create an example portfolio, but I'm not suggesting that you should necessarily yourself buy any of these tokens. The point of this video is to help you make sound decisions if you choose to invest in crypto, which is a decision you'll have to make on your own. All right, so let's talk about the framework we're going to use today. The great thing about crypto-based businesses, and that's what most protocols are, right? We're not talking about networks here, but we're talking about applications that are built on a blockchain. At the end of the day, it's a business, right? People think of it as, they talk about it as a community, as a DAO. At the end of the day, it's a type of business, right? It's a new type of business that uses a new type of financial rail. But at the end of the day, it's a business. In most cases, it's a financial business. And so that means that if you're choosing to invest in it, you can assess it based on whether it's actually producing money. And the cool thing about something being built on a blockchain is that that's all transparent. So for a lot of these things, we have revenue data down to the hour. I don't know why you would really need that. If you're investing based on fundamentals, right? We're not talking about like quantitative trading here, but at a minimum, you have revenue daily, you have it weekly, you have it monthly. You don't need to wait for quarterly reports, which is pretty cool. And I think that this is going to start to become the standard now that people get a taste for that sort of readily available data. And so let's talk about how we're going to do that. For most of the analysis today, we're going to use this website, DeFi Llama, which by the way, I happen to work for, but DeFi Llama tracks the financials of various financial applications, and they have revenue for over 1,000 protocols. So it's ideal for this sort of analysis. This is their homepage here. The homepage is entirely free. And basically, we're going to look for protocols that fulfill three criteria. First, we want a low market cap to revenue ratio. So we want something that is producing a lot of money compared to the actual price of that asset. And revenue in this case, this is just the lexicon that's evolved in the crypto industry, is revenue that's accruing to the protocol in some way. It's more comparable to net income from traditional finance. So you've want protocols that have a lot of net income compared to their market cap, right? Makes sense. Second, you want protocols that have consistent revenue over time. One thing you'll see in crypto is that a month in crypto is kind of like a year in the traditional markets because things are so volatile, they move so fast. And so oftentimes if you just look at the revenue over the past month, you say, wow, this thing is making so much money, but in reality, it's only making money this month and then it's going to disappear. So we want something that's been consistently producing revenue, ideally over multiple years, at a minimum 1 to 2 years, because again, like a year in crypto is like several years in traditional markets because the industry. And third, we want protocols that don't have a ton of dilution coming in the future, at least compared to the revenue that they're creating. A lot of protocols you'll see in crypto, they launch the token and only 10% or even less, sometimes 5%, 1% rarely are in circulation. And then the rest of those tokens are going to come on the market, eventually dilute current token holders. And it doesn't really matter how much revenue they're producing if they have that sort of dilution coming in the future. So to recap, three things we're looking for. We want high revenue, or you could call it earnings, compared to the market cap. We want consistent revenue over time. And we want low future dilution, especially compared to the current revenue. All right, so let's take a look at that. But before we start, question that I know some people are going to ask is, should this be your entire portfolio? And the answer is no. Should your entire portfolio be these sorts of income producing cryptos? And I would argue In most cases, I always recommend an allocation to the majors. By that, I mean the top 10, Bitcoin, Ethereum, XRP, BNB, Solana. And that doesn't mean you need to hold all of them, but I think some portion of someone's portfolio, if they're investing in the digital asset market, you want to have those. At a minimum, could be Bitcoin, could be Ethereum. Again, I can't tell you which ones to buy. But if you don't have those, then you're going to be much more subject to market dips. And these are the sort of protocols that have survived multiple downturns now, oftentimes multiple near industry destroying events. So you can be much more confident that if you went into a coma, woke up in 10 years, these would still be around. Tougher to be confident with a startup that's maybe only been around for a year. And so as a result of this, when I talk about building a passive income producing portfolio today, I'm going to put 50% of the allocation towards these types of tokens, and I'll talk about some strategies for earning yield on them. All right, so we can talk about that first. If you're looking at these majors, how do you earn yield on them? In most cases, it's going to be one of two ways, and these are going to be the simplest. Either if it's a proof of stake protocol like Ethereum or Solana, you can stake it or liquid stake it, and the rewards are not going to be anything out of this world, but you will earn a consistent protocol native yield. If it's not that, or even if it is in addition to that, you can lend it out. You can lend it out using decentralized protocols like Aave. If you have a proof of stake token like Ethereum or Solana, then these are the sorts of yields that you can expect. Ethereum, the current reward is around 2.94%, and for Solana, it's 7.26%. Again, nothing that's necessarily life-changing, but part of what I'm going to try to show you today is that if you have some sort of allocation to crypto and you adopt some of these strategies, then you can start to earn some modest income to supplement your other income, and that you can reinvest into the market. So this is going to be the most basic way, is just liquid staking or lending. And if you're watching this channel, it's a DeFi channel, you're probably already familiar with this. If you want to get a higher yield or go a bit deeper, something else you can consider is investing in the liquidity pools for perp protocols. All right, what the heck does that mean? Perps are basically you're trading a type of derivative, and it's one of the most profitable businesses in crypto. And for perps that are built in a decentralized way, they're built on chain, they need someone to provide liquidity to those perps. And oftentimes, because it's such a profitable business, providing liquidity to those types of protocols can be extremely lucrative. And so, for example, Jupiter, which is probably the most well-known perps pool that you can provide liquidity to, currently you can earn 29.71%. You can do this with basically any size you want. $1.8 billion are deposited, and your deposit is going to be a basket of Solana, ETH, Bitcoin, and stablecoins. So it's entirely stablecoins and the majors. Now, this one is heavily weighted towards Solana because it's on Solana itself. However, there are some perps platforms that are built on other networks like Ethereum layer 2s that are going to be more weighted towards Ethereum. But I think that this sort of perp thing, if you're looking purely for passive income, it's a great way to allocate that portion of the portfolio that is majors. So that's definitely going to feature in the portfolio today. So to recap, we now have 50% of the portfolio that's going to be in some combination of liquid staking assets and this sort of perp liquidity pool. The other 50% is we're looking for these fundamentally sound tokens, the quote crypto value investing type tokens. And so let's take a look at these again using DeFi Llama. So I selected the revenue toggle here. I'll zoom in so it's a little easier for you guys to see. And I'm just going to customize the columns to make this a bit simpler. Let's see, we don't need 7 days. We won't be looking at incentives yet. We will, let's see. What we do want though is we want price to sales ratio, because what we're going to do is we're going to look for things with a low price to sales ratio. And you can see that some of these are extraordinarily low, especially if you come from the world of TradFi. You're like, how in the world is that possible? That something's market cap is 1/5 of its annualized revenue. In many cases, I'm not talking about these specific protocols. I don't necessarily know all of them, but in many cases, this is because their revenue for the past month, which has been annualized, is unusually high. And so when you annualize it, you end up getting a revenue that's extremely high. And in some cases, they may not have a full year of data yet. But like most people predict, and most people know who invest in crypto, that revenue is not necessarily going to last. And so they end up with a lower valuation because the market correctly predicts that the revenue is only a temporary thing. However, if you look at some of these protocols, and we'll aim to find some today, what you'll find is that they actually do have revenue that has a bit more staying power. For example, I'll pick this protocol SideShift, which is labeled as a member of the cross-chain bridge category. I can see the fees here. I'm going to chart revenue instead, and I'll aggregate it monthly. And what I can see here is that going back a year, the monthly revenue has actually been relatively consistent, right? It has ups and downs, a swing of maybe 50% down, seasonality or related to the market cycles. However, you can see that it's not something that was just elevated for a single month. It's been consistent for at least a year, which is equivalent to, I would say, several years outside of crypto. So that's a good sign that this could be something that's worth exploring. Let's find a few others. Another one we can look at is Pump. Now this one's interesting because this protocol has been perhaps one of the biggest drivers of the market over the past few years, simply because the meme coin craze of the past 12 months started on Pump. Now this is a good example of one that had a huge spike in revenue, followed by some major dips. It went from $137 million in revenue in January down to a low of $20.59 million of revenue last month, and then it's started to rebound this month, which isn't over yet. Now, this doesn't mean that you shouldn't necessarily invest, because you still have to look at the revenue compared to the market cap, and as we saw a second ago, it's actually still quite high compared to the market cap. But you would have to assess whether you thought the team could maintain or increase this revenue, or if it would keep falling, and that comes down to the sort of qualitative analysis that goes beyond just these sorts of financials. Next, we can look for another example. I'll keep scrolling down, and we can look at something like this GMX protocol. GMX is another perps platform, and total value locked is liquidity on the platform. But what we're really looking for now is we want to see revenue. And so what we can see here is this has actually had some major ups and downs. It's been around for over 3 years, and actually almost 4 years it's been around. And since its first period of growth into 2022, it's had some periods that was way up, period that it's way down, but it's actually been somewhat consistent for going on 4 years now, which is like a lifetime in the world of crypto. And so if you're following along, we've now looked at 2 of the 3 things that I said we were going to assess. We've looked at protocols that have a low market cap compared to the money they're bringing in. And then we've assessed the revenue of those protocols over time to find ones that actually have consistent revenues. The next thing that we want to look for is we want to check, do these protocols have a lot of future dilution coming? All right, so let's take a look at these. Here we have, as an example, GMX. And one simple way to check whether it has a lot of dilution coming is you want to compare the market cap to the fully diluted valuation. Fully diluted valuation right here is the market cap of all of the tokens that could ever be in circulation were released. And what we see here is that in this case, the market cap and FDV are exactly the same. They're both $152 million. And CoinGecko is actually another great resource for this. They're built around prices and market cap, so it makes it a bit easier to see. But this is not, the point isn't to push any particular token, but we see in this case, okay, the FDV and the market cap are the same, so you don't really have to expect a lot of future dilution. If we look at this one, Pump, for example, then what we see here is that the market cap is around $1 billion, just under $1 billion. The FDV is more than 3 times that. That means that fewer than a third of the tokens that will ever be in circulation are currently in circulation. And so even if the market cap seems low compared to the revenue now, in reality, you're going to be diluted in the future, and you have to be careful of that. To recap, we've now found protocols that are producing high revenue compared to their market cap, that are producing that revenue consistently over time, and that don't have a ton of future dilution coming. And before I made this video, I went through and looked at dozens of protocols to find ones that fit this criteria for this sample portfolio that I'm going to present. But before I get into that, I want to give a couple caveats. First off, this is not my actual portfolio, and again, I'm not suggesting it should be yours. And second, I left off a few protocols that actually I think have some of the best fundamentals for this portfolio, for the reason being that I wanted to demonstrate the sort of dividend-based passive income that you can earn from investing in these on-chain decentralized finance businesses. And that means that I left out protocols that either don't pass on revenue to token holders yet because they're reinvesting it into the business, or that pass on that revenue to token holders in the form of buybacks. And that one's especially important because if you look at the highest revenue producing applications, you have stablecoins, of course, but then you have Pump and Hyperliquid. We already talked about Pump in this video. And if you look at the highest, if you look at the market share of revenue that's being passed on to token holders. So this chart here shows the percent of all revenue that's being passed on to token holders by protocol. You see a majority of the DeFi revenue going to token holders is from those two protocols, Hyperliquid and Pump. Huge majority, in fact. And I left those off the portfolio for the reason being that since they're passing it on in the form of buybacks, it's not really an income producing asset right now. It may do well in price, but it's not actually like giving you a dividend. Hyperliquid, there is a way to earn yield by staking it, but it's relatively low. So again, I left these off of this portfolio, but that's not to say that they're not fundamentally sound investments. So let's talk about the protocols that I did select for this sample portfolio. To start, I have a couple that we already covered. I selected GMX, which has been a consistent revenue earner for several years and is a perpdex, one of the most proven business models in crypto. Additionally, I selected this SideShift portfolio for a small allocation. Small because it's still relatively small. $24 million market cap is I would consider to be in the very high risk category, but it's produced consistent revenue compared to its market cap for a full year now. Other protocols that I selected were Aerodrome. Aerodrome is the leading exchange on Coinbase's Base network, and it's produced consistent income for 2 years, and it actually passes all of that income onto token holders as a dividend. Now, interesting thing about Aerodrome is token holders can actually earn additional income by voting on how you're going to distribute Aero incentives to people who are providing liquidity on the platform. And so this revenue doesn't actually fully capture how much income the token holders themselves earn. And we'll see that when we look at the average rewards for Aero holders. And then finally, I selected this FX protocol. You can see here, although it's had ups and downs, the current level of revenue it's been able to maintain for almost 2 years now. And this one is a bit more financially complex. Basically, this protocol splits ETH into a mix of low volatility floating stablecoins and high volatility leveraged ETH tokens. And this one is a bit more financially complex. The way that they describe themselves is that they're a decentralized perpetual trading platform that enables leverage on ETH and BTC while delivering high USD-based yields to FXUSD and USDC stakers. You can see here it says that it splits yield-bearing assets into a decentralized stablecoin and a leveraged asset. So it's a bit more financially complex. But what's interesting from our perspective, or perhaps most interesting, is that it's been producing a lot of income from this, and it's actually been experiencing a huge growth in liquidity on the platform recently, although we are more interested in revenue for this exercise. All right, so you can go to all of these things and you can look at what the current APRs are if you were to hold these tokens and then earn income from these tokens. And so we'll look at the sample portfolio now. And we can see here that I have Aero, FXN, XAI, which is the SideShift token, GMX. Additionally, I set a 25% allocation to JLP. That's the Jupiter liquidity, perp liquidity token. And then also a 25% allocation towards staked ETH. Now, staked ETH has the lowest APR here. However, I thought that it was still necessary to include because you want to have some of your portfolio in those sorts of large caps, which will naturally have a lower APR. And you can see here that if you look at these dividend producing cryptos, because it's such a high risk industry, the standard expected APR seems to be between 10 to 30%, 15 to 30%, which again, it's much higher risk than your typical income producing stock. So that kind of makes sense. And for a sample portfolio of say $10,000, the average APR on this, the weighted APR, would come out to around 18.7%. So you'd be making around $1,900 a year or $156 a month. And if you had less, say you had 1,000, you'd be looking at around $200 for the year, right? Maybe you would have more, you'd be making more. Now we'll go back to 10,000. Why am I showing you this, right? Especially when I said this is not my portfolio. The reason I'm showing you this is if you chose to allocate some of your portfolio to this kind of income producing strategy, then suddenly you have this monthly income, which maybe can help offset a bill, or maybe it's your new investment allocation to crypto, where you can use this to invest in other things. And I want to make the case that as you see this industry grow, and I think it's going to continue to grow, you're going to see a lot of these DeFi applications, the amount that they earn is actually going to increase significantly because you're going to have real finance start to take place on chain. This has already started to happen. And so the way that you can look at investing in these is not just you're buying some token that you're hoping someone on TikTok is going to pump. You're buying a share of a business that's using blockchain to provide a financial service. And if you believe that that technology is going to grow, then you would naturally believe that those businesses would make more income in the future. So maybe this Arrow is earning 25% compared to its market cap currently. Perhaps in 3 years, you bought at today's price, it's earning 30, 40% compared to the price you bought at. And the reason being is that the business would grow, and then suddenly you have this phenomenal income producing portfolio. And if you want more of this type of analysis, I do a lot more of it in much more detail on my Substack newsletter at dynamodefi.com. I include a metrics newsletter every week, a weekly news update, and market analysis newsletter. Basically, the idea is to give you everything you need to navigate the crypto market in one single Substack. Check it out, newsletter.dynamodefi.com. And if you want more videos like this, be sure to like and subscribe. Until next time, this is Dynamo DeFi.